A company can post 2 million of profit on Monday and still not be able to meet payroll by Friday. It sounds impossible, but then it does happen. I will show you how exactly it can happen in this video. Welcome to Toyosi's Finance, where we break down money, business, and strategy in simpler terms. In this video, we'll cover how profit and cash can diverge. Second, how working capital, receivables, payables, and inventory can drain a profitable business in a quarter. And thirdly, why Capex doesn't show up in profit but it shows up in the bank. And fourth, how revenue recognition rules allow you to book a revenue years before you even see the cash. Let's get into it. First, meet BrightHome Furniture. It has revenue of 15 million, cost of goods sold of 4 million, and a gross profit of 7 million. OPEX is 4.8 million, and that leaves us with an operating profit of 2.2 million. And then we have interest and tax expenses of 1 million, and we're left with a net profit of 1.2 million. You should also note that revenue actually grew by 30% this year. On paper, this is a success story, but in reality, it's actually not the case because BrightHome actually started the year with 200k in cash and ended the year with a 600k bank overdraft. That is an 800k cash outflow in a year that it made 1.2 million in profit. Now let's reconcile the gap between the profit and the cash. The first and biggest leak is actually the working capital. The working capital comprises of the receivables, payables, and inventory. Last year, BrightHome actually collected receivables on average of 45 days, but this year they've pushed into larger retailers, for example, IKEA, Carrefour, and these big retailers actually pay them on average of 90 days. So 15 million of revenue, that alone is about 1.8 million more in receivables, which is cash that you have earned, you've invoiced, but you have not yet collected. Well, for inventory, they actually built stock ahead of the Christmas peak, so inventory went from 800k to 1.4 million, which is 600k of cash turned into silver that is just sitting in the warehouse. And for payables, they actually pay their suppliers faster to be able to lock in a 1% discount. So payables went from 1 million to 700k. That's 300k cash out the door to be able to save a 30k discount, and that is bad trade. You should note that revenue growth actually consumes cash before it generates it. So if your revenue growth is growing by 30% but your working capital scales linearly, then you need 30% more cash before the profit arrives. Next leak is actually Capex and depreciation. Brighton bought a new furniture for 600k, so he paid his supplier full cash of 600k, but on the P&L, the machine gets depreciated over the useful life of the asset, say 5 years, so only 120k will hit the P&L this year. The P&L only reduces cash by 120k, which is the amount for the year, while the bank actually reduces by 600k, which is the amount of the asset. So you're 480k out of pocket than the P&L actually suggests. So every year that you invest more than you depreciate, cash actually drains faster than profit. There's a number for this, it's called the Capex to depreciation ratio. And if the point is more than 1.2 for more than 2 years, then you are in an investment phase and your profit is overstating your cash generation. And it's fine as long as your EBITDA is growing fast enough to be able to fund it. It becomes dangerous when the ratio is high and the EBITDA growth actually stalls. Now let's look at another leak, which is the revenue recognition rules. Under IFRS 15 and US GAAP ASC 606, revenue is recognized when you transfer control of product or service, not when you invoice, not when you get paid, but when customer actually receives the value. Now, let's look at a real life example. A SaaS company bills a client for a 3-year contract for 300k, and in year 1, they provide the service and the customer pays 100k. If the customer pays on day 1, they paid upfront, and that is actually beneficial for the cash. But let's flip it. A services company bills its client for a 2-year contract for 1 million. So in year 1, they deliver 30% of the contract, but the contract says they can only bill in 3 milestones: signing, 50%, and at the end of the contract. So at signing, they're only able to bill 20%, which means they can only bill 200k, even though they've already recognized 300k for the first year. And the gap between revenue recognized and cash collected is actually unbilled revenue. And if this amount keeps growing quarter on quarter, then you have a cash bump under your business. Revenue recognition policies look fine, but the bank account tells a different story. Anytime unbilled revenue is growing faster than invoiced revenue, you should actually try to understand why. You should open the contract and look at it, because 9 out of 10 times it's actually a milestone problem. Here is a 10-second stress test that you can actually run on any business. It's cash from operating activities divided by net income, and you can pull in both numbers from the cash flow statement and the P&L. And healthy businesses actually convert 80% or more, while mature businesses or companies with mature working capital convert 100% or more. And if this number is under 50% for more than 2 quarters, there's actually a problem. It's either your working capital is blowing out or unbilled revenue is also growing. You should actually investigate it to see what the problem might be. So using the case of Bright Home example, we have the net income of 1.2 million. Add back depreciation and amortization of 400k and deduct 2.7 million working capital drag, and then we're left with minus 1.1 million cash from operations. So when we divide the minus 1.1 million divided by 1.2 net income, we actually have a minus 92%. So for every euro of profit that's actually generated, Bright Home is actually losing 92 cents of actual cash. No amount of revenue growth is actually going to save them. They either need to fix their working capital or raise capital immediately. If you diagnose a cash profit gap, then you can actually fix it using one of these levers. First, you should renegotiate your customer credit terms. 90 days is a choice, it's not actually a law. Then, offer a 1% discount for 45 days of payment, and most retailers will actually take it. Then, you should tighten collection cadence. You should do weekly done in ones, send automated reminders, or even set up direct debits where possible. Next, you should push inventory turns. You should do just in time ordering and also SKU rationalizations. Also, Capex discipline, you should stagger investments and you should also negotiate payment terms with suppliers. Lastly, milestone invoicing on services contracts. Invoicing at the beginning of the contract, at signing, at kickoff, not just at the end of the contract. Any one of these levels can actually save your business 1 or 2 days of cash conversion. And if you do two or more, you could actually have bought your business 1 month of runway. Thank you for watching this video. If you found it useful, give it a thumbs up and also follow at Toyosi's Finance. Goodbye.